Hi, everybody. Thomas here. Going to talk today about one of the most recognizable companies and brands in the world. That's the Walt Disney Company, and whether or not this is a stock that right now represents a really big bargain or should really be considered as sucker's bet. Let's dive straight in. Despite being one of the most recognizable companies in the world, after all, everybody recognizes Mickey Mouse, the stock has been following a clear downward trend. We can trace it all the way from a peak above $200 in late 2020, all the way down to a low point at the start of 2023, down around 90, maybe a little bit below that. More recently, and the interesting thing as of current news is that Disney has broken down below that previous low and is setting up a new low right around $83 per share as of the close of the market this last Friday. That starts to beg the question of whether or not the stock has fallen far enough that it might represent a good buy. Is this a stock that is radioactive and everybody should be staying away from? What exactly is going on? Now, there's a few different elements to think about here. One of the things that I like to go back to when I start going through this analysis is to think about the basic kinds of patterns that I'm trying to identify with my rebel income trades and trying to find the right opportunity under the right conditions for the kinds of trades that I like to make with my put selling trades. And so on my chart, the blue line represents my 200-day moving average. And we can see that that has been going down, which of course isn't surprising given the stock's movement over the past 2 years. The 20-period moving average as well is also going down and is continuing to go down. Now, with the stock down well below the 200-period moving average, then the kind of signal that I would be looking for would be my traditional bullish level 2 kind of pattern, where I see the 200-period moving average going down, hopefully starting to flatten out. And then the 20-period moving average, by comparison, also going down, having dropped below the 200-period moving average, starting to flatten out and possibly even starting to move back up with some price activity based on the weekly candlesticks showing that the stock is starting to pick up some positive momentum. Well, right now we have exactly the opposite, where the stock's latest activity and price movement is clearly below the 20-period moving average. It's not above it. It's not showing any kind of bullish momentum. In fact, if anything, in the last 2 weeks, it's picked up more bearish momentum. Is that where the conversation stops? Is this where we say there's just not a good opportunity here with Disney, or is there something more to it? The truth is that this is a pretty low probability setup if you're thinking about buying the stock right now or trying to look for a very, very near-term bullish kind of trade. From a value standpoint and from the standpoint of thinking about the stock from a long-term perspective, it does start to beg the question, though, of whether or not the stock's current price down here at around $83 is low enough to represent a good value. If it does, and the company's fundamentals are strong enough, it's possible that you may be in a position where the stock may be worth starting to consider as a good bargain buy. So let's run the numbers really quickly and see what the fundamentals and the value propositions suggest about Disney. As always, here's the really quick review of the fundamentals that I focus on. I'm going to pay attention to free cash flow. The company's balance sheet is really important to me, so I pay a lot of attention to the amount of cash they have versus long-term debt. I like to compare net income to revenue to try to measure a company's profitability. And then whether or not the company pays a dividend is a major qualifier for whether or not the stock is worth one of the trades that I like to place with my Rebel income generation system. As far as the valuation is concerned, my primary criteria are price to book and price to cash flow values, relative and compared to historical norms. What has the stock market previously used for normal valuation levels for a stock, and compared to where the stock may be now and where those levels may be, does that suggest that these might represent a good value? Here's the summary for Walt Disney. And there are, in all honesty, from a fundamental standpoint, a lot of things to like. There's some very, very good things about what's going on. If we look at free cash flow over the past year, we notice that from about a little over $1 billion a year ago, it declined very sharply to $94 million 3 quarters ago. On the other hand, from that point, free cash flow has been showing some steady improvements. We can see that from 94 million in the next quarter, it went up to about 1.4 billion. And as of the most recent quarter we reported, was up a little bit below 3 billion to about 2.8 billion dollars. Free cash flow growth is a very strong sign of fundamental strength and a good sign that profitability is improving, that the company's bottom line is improving. That is also reflected, and we have a similar kind of pattern in the amount of cash that the company has had on hand over the same periods. We see a drop from 11.6 billion to a little under 8.5 billion from a year ago to 3 quarters ago. But from that point, steady improvement again from about that 8.5 billion mark to just a little under 11.5 billion in the most recent quarter. In the meantime, long-term debt has remained pretty steady and in fact has declined by about $800 million over the past year, from about $45.3 billion to a little over $44.5 billion. Long-term debt is not categorically a bad thing if the company's operating profile shows that they can service their debt, then debt can be used for a lot of very practical and productive purposes. So the real question is how serviceable the debt is. Can the company pay their debt obligations without difficulty? This is where the evaluation of net income to revenue becomes useful for me. And if we look at that on a trailing 12-month basis over the past year, that net income to revenue percentage works out to about 2.5%, which is pretty narrow, but doesn't necessarily mean that the profitability is a problem. It just means that the company operates with relatively narrow profit margins and has for the past year. In the case of Disney, though, there is a red flag, and that is in the last quarter, because this same metric dropped below zero. In fact, it's now negative at -2%. And so this is a proverbial red flag. And this is something that I would consider to be a warning sign about the company's ability to maintain profitable operations. It doesn't mean that they can't pay their debt, but it does mean that this healthy cash position that they have is likely to be eroded by their long-term debt payments. A continued pattern of negative net income is also not sustainable, simply because a company cannot continue to pay out more than it is bringing in, and that's what the implication is when you see negative net income in this form. So there's some positives. There's a few significant things to be concerned about, but all of these things taken together, when you compare this against the company's value proposition, the stock's drop in value from about that $200 level that we just mentioned down to its current price, a little bit above $83, has really put it in an interesting situation and position as an interesting value opportunity. And right now, if we just compare based on historical price to book and historical price to cash flow levels, the potential upside if the stock were to reverse and start to go back up could be close to about 200% from the stock's current price, up at around $244 per share, which is really interesting. So the stock certainly looks like a tempting value at this price. One of the filters and primary criteria that I use in my analysis is whether or not a company pays dividends. Disney does not. They were paying a very consistent dividend until the pandemic of 2020, and then at that time they suspended their dividend in order to preserve cash, and they have not reinstated it, where a number of other major companies in the S&P 500 have reinstated dividends and even begun increasing them. Disney has not. And so this is also something that I would consider to be a red flag. So right here, annual dividend of 0 and obviously a dividend yield of 0. All those things being equal, then one of the next questions should be, if you are tempted to try to take advantage of what looks like a very tempting value proposition with the stock's long-term price possibly up near around $200, is whether or not the stock's current downward trend continues. How much further could it go down? To try to facilitate this analysis, I've extended my stock chart out to cover about the last 14 years of price activity, and there's a good reason for this. The stock is down at levels last seen in late 2014. And so it's been almost 10 years since the stock was down at around these levels, although we did see a drop into this neighborhood briefly during the pandemic. The question becomes, if the stock's current bearish price momentum continues, how much further could it go down? Well, if I use previous pivot activity, in other words, previous points where the stock had experienced a reversal up to down or down to up, I can try to use those to identify where next future levels of support could be if the stock continues to fall below its current price at around $83. This line is an interesting one, which falls into the neighborhood of about $72 per share, roughly, something around in that neighborhood, which says that if the stock's bearish momentum continues, we could see its next major support point somewhere about $10 to $11 below the stock's current price. If that doesn't hold, then it may be even lower, somewhere in around this $60 range, maybe a little bit above that. We'll go ahead and just say, for the sake of argument, we'll say $62. So just based on bearish momentum, it looks like there's a lot of downside in Apple right now. What about if the stock were to stabilize and start to go back up again? Is there a bearish case to be made? And so let's take a look at that view a little bit. If the stock were to stabilize and reverse and give the kind of pattern that we like to see with the bullish level 2 pattern, where bullish momentum from price movement is starting to look positive, and that 20 period moving average is starting to curve upward the way that we like, the stock would probably have to push up into the neighborhood of about $90. This is pretty consistent with the 20 period moving average, which right now is right around $91 per share. If it breaks up above this, then we will probably see the 20 period moving average starting to curve upward. We'll probably start to see some indications that the kind of bullish level 2 pattern that we like to see could be materializing here. If the stock does continue to rally, how far could it go in the very near term, or possibly longer if it actually starts to reverse its upward trend? Well, we've got, again, if we use prior highs, prior lows above the stock's current price to identify where some of those may be, we can see a lot of activity previously occurred right around here, a little bit above 100. And I'll go ahead and call that 103 for the sake of argument. So we could see if the stock starts to recover and push upwards, we could see some future resistance at around 103. We've probably got some right here around 110. And again, at a little bit above 120, I'll go ahead and just call this 121 roughly. I've also drawn a Fibonacci trend line to show you where Fibonacci trend analysis, which is very good for identifying high probability reversal points within trends. The 38.2% retracement line falls around 128. We have the 200 period moving average at around 131. And the 50% retracement line sitting right around 142. So if the stock can start to rally and start to build some bullish strength and a new bullish trend, there is some opportunity, but we can see a lot of potential resistance points that it's going to have to break above in order to start building that trend, and in order to start building the kind of bullish momentum that is going to bring the market back and start to be interested in this stock. All of that considered, along with kind of the mixed bag of fundamentals, even with the stock's very tempting value proposition, I'm going to go ahead and put Disney into the category simply of a sucker's bet. Thanks, everybody.